Several Democratic presidential candidates propose to raise taxes on the rich. They argue that the people who have done well in recent years should bear the burden of the cost of expanding programs that would help the rest of the population. They'd also use the tax code to reduce inequality more aggressively than today's tax code does. And they say that if the budget deficit is a problem, well-off folks ought to pay more taxes to shrink it. Opponents say the rich already pay their fair share of taxes and warn that raising taxes will have unwelcome side effects, such as less investment and slower economic growth. Let's start with some definitions. What do we mean when we talk about rich Americans? There are the well-off. About 9% of the households in the U.S. have incomes greater than $200,000, and they get almost 45% of all pre-tax income. Then there are the really rich. 0.4% of the households in the U.S., about 700,000 in all, have incomes above $1 million a year. That 0.4, they get 13% of all pre-tax income. Since the early 1980s, those at the very top have enjoyed faster growing incomes than the rest of us. The rich generally do pay more of their income in taxes than other Americans do. The top 1% got 16% of the income and paid 25% of the taxes. Factor in government benefits like Social Security and food stamps and the like, which help lower-income folks more than those at the top, and the rich still are doing better. The after-tax and benefits income of the top 1% rose by 226% between 1979 and 2016, nearly 5 times faster than the incomes of people in the middle. So, if we wanted to raise taxes on the rich, how might we do it? We lay out some options in our voter vitals. One might increase income taxes on the upper income people or make higher wage workers pay more in Social Security payroll taxes. But the freshest idea in the debate is the wealth tax. Now, wealth is different than income. Income is what you earn from your labor each year, as well as interest, dividends, and capital gains. Wealth is the value of the things you own: stocks, bonds, house, yachts. The federal government generally taxes income, but doesn't tax wealth except when you sell an asset, such as a share of stock. The Federal Reserve estimates that the top 1% holds slightly more wealth than the entire bottom 90% of the population, and their share has been rising over time. Senator Elizabeth Warren, the Massachusetts Democrat who's running for president, would impose a 2% annual tax on households with a net worth of more than $50 million and a 3% tax on every dollar of net worth over $1 billion. So a family worth $60 million would owe $200,000 in wealth taxes on top of their income taxes. The developers of this tax, economists Emmanuel Saez and Gabriel Zuckman of the University of California at Berkeley, estimate that only 75,000 households would pay this tax. Advocates say a wealth tax would dilute the largest fortunes in the U.S. and restrain the emergence of a plutocracy. Of course, it could encourage the wealthy to dissipate their money, giving it to charity or giving it to their children to avoid the tax. But even so, it could still raise a lot of money. Saez and Zuckman say it could yield $2.75 trillion over 10 years. Critics, including former Treasury Secretary Larry Summers, say that's a substantial overestimate. Opponents of the wealth tax say it could discourage or penalize the most successful entrepreneurs, not just hit old money. And they note that these sorts of taxes are very hard to administer. The IRS would have to value art collections and antiques, for instance, and they could spur creative tax avoidance. Now, back in 1990, a dozen developed countries had wealth taxes, but because they're so hard to administer, only 3 do today: Norway, Spain, and Switzerland. Presidential campaigns are full of fiery rhetoric and bold promises, but they're also an occasion to highlight big problems and examine various solutions. The wealth tax is one example. To learn more about this and other issues, check out our voter vitals at brookings.edu/policy2020.